Hello and welcome to Editor's Take. Today, Reserve Bank of India Governor Dr. Subba Rao announced his latest and perhaps his last monetary policy. To discuss what he said today and what the implications are for the Indian economy and the Indian financial system, we have with us Tamal Bandhyopadhyay, who is Mint's Deputy Managing Editor and in-house banking expert. So Tamal, first take, what is your view? What has Subba Rao essentially signaled? What are his big concerns that he has spoken about?
Well, there is clearly a shift. Till recently, he used to talk about growth and inflation. Yeah. But I think now the priority number one is neither growth nor inflation, but protecting Indian economy and Indian market from the external shocks. So to that extent, it's not Dr. Subba Rao, but actually it's Ben Bernanke who will decide what's going to happen in India. Because whatever we have seen, the impact on the rupee, it's all followed after the 22nd May Bernanke announcement on the tapering off of the QE3, the money flow. And we saw wide-scale, large-scale sell-off both of bonds and equities, and rupee hit its record low. And we are still reeling under that. So, which Subba Rao has made it very clear, yes, he is concerned about growth, but a bigger concern is the external macroeconomic scenario. Yeah. So, that's the key takeaway from the policy, I think.
Okay, because in the policy he spoke about the impossible trinity again, and essentially what he was signaling was that if you have an open capital account and you are targeting the rupee, then the monetary policy basically is outsourced. So yeah, that's where your point about Bernanke comes in. Now, these past few weeks, the Reserve Bank, to protect the rupee, has come up with slightly controversial moves, tighten liquidity. And you've also written about how these eventually will be rolled back, they're temporary, and the finance ministry has also spoken about this. Do you get any sense in this policy about whether there's any time frame or even a ballpark understanding about how close we are to a tapering up of the tightening liquidity?
No, I haven't got anything. The policy documents talks about calibrated rollback. So, but that's a very technical and academic way of putting things. I think one of the reasons why the governor can't afford to say that, because the moment you actually put up a time frame, you are making the very policy ineffective. That shock value and the mystery about it, how long it will continue. So the speculators would say, look, it's just a question of 2 weeks or 3 weeks and we'll be back. Exporters would say, look, let's hold on to our plan of bringing back dollars. Or importers will say, look, again the rupee will go down, so let's buy it now. So I think my personal take is that he has not said anything specific, but that does not mean that the rollback is far away. It could be even a month away or 6 weeks away. But I think from now on, what Bernanke does, what the FOMC meeting does and says, it's more critical for India, and everything what would happen on the mean road would depend on what FOMC says.
Indeed, but just a small follow-up question, and Tamal, you have sort of tracked central banking in India for well over a decade, and you have seen several central bankers at very close quarters, and Dr. Jalan had also hit the market with extremely tough conditions during the 1997-98 Asian crisis, and those were rolled back. So what was the time frame then? I'm not saying that necessarily it would translate into a similar time frame then, but just looking now, but looking back, do you remember how soon Dr. Jalan had?
It was pretty soon. But I think we need to understand one thing. That time the world was not as closely knit as it is now, and the character and the profile of market also is very different. So on the one hand, we continue to talk about our we had very small reserve at that time, and how effectively Jalan did hit the speculators. There was an element of surprise, and how the current regime has not been able to do so. But we need to see the market was very different at that time, and the global scenario, I mean, the world was not so integrated. So I don't think the comparison would work. But it's the same textbook measure that we saw in 1997, 98, and that we have seen now. So there it ends, I would think. There's the comparison, yes, but the context is very different.
But Tamal, would my reading be correct if I say that if the RBI has to go back to its easing stance of supporting growth, now that inflation does seem to be coming off, that first it would roll back its liquidity tightening measures and then go in for a repo cut? So first they would signal a loosening by rolling back these measures, and then perhaps in the future, would that be how it would play out?
That's absolutely logical. That's going to happen. But what is interesting is to see RBI's priority. Now, if you have seen the text of the policy, when it talks about the stance and priorities, it's to be wary and to be watchful about the external scenario. That's the point number one. B, it's the risk to growth. C is inflation, and D is making liquidity available so that there is a credit inflow to the productive sector. So it's the least of the priorities is making money available in the system to meet the credit demand for the productive purposes. Now this and the second thing, growth, is interlinked, but by putting it at number 4, I think he is making it pretty clear that, look, I am not in a hurry to ease the liquidity measures and bring back. But yes, you are absolutely correct. When the liquidity at the first stage, we will see the rollback that will bring back the earlier situation, and then perhaps if the inflation continues to be low, particularly the retail inflation, then we might see even a further cut in the interest rate. But everything depends on what FOMC does. Can I ask you one question?
Yeah, sure.
Niranjan? You are a hawk all along in your editorial.
Yeah.
You have been asking about pushing for rate hike.
Yeah.
So I think you should be very happy about what you are seeing in now as an economist.
Yeah, indeed. See, because our view on the editorial page has always been that we first have to get a sense about whether Indian monetary policy was too low in the first place. We talk about tightening, but it could be even a normalization of interest rates. And if you look at a lot of academic research on what is called the Taylor rule, which tries to judge whether interest rates, how close interest rates are to their correct level. Indian monetary policy has been loose. A lot of monetary policy across Asia has been loose. So if you see Brazil, Turkey, China, in various ways, for different reasons, they have been tightening policy. The US has signaled a tightening of policy. So I think that given the state of the economy, which we still have high inflation, we still have a high current account deficit, there is a case for hawkishness, or at least less dovishness than there is overall in the financial markets. So that's essentially why we argued the way we did. And I think we argued this before he tightened. So in a way, it feels good to see that we sort of got it right ahead of the RBI. So that was Tamal Bandhyopadhyay explaining what the current monetary policy means. He makes two very significant points. One is that the governor is clearly concerned about external risks more than the internal issues. And I think the second big point he makes is that what Ben Bernanke does will be a key factor in monetary policy in the coming months. That's all for now from Editor's Take. Do log in to www.livemint.com for future updates. Thank you.